Expense ratio, why it is one of the most critical ratio to consider when investing in a mutual fund, how expense ratio can dampen your returns from the equity market. So if you want to know answer to each of these questions, keep watching. What is expense ratio? Expense ratio is the expense that an investor pays for investing in any fund. So it's the fund house that charges a certain amount of fee for managing the fund. The expenses can be the fund manager's salary or administrative cost or the commissions they pay to their subsequent agents or advertising cost. Anything and everything that a fund has to incur a cost, that is managed within the expense ratio. As an investor, you are paying that expense ratio each year. As an example, let's say a fund manages 10,000 crores, and if it charges 1% as expense ratio, then 100 crore will be its charges for all managing the fund. That would include everything. I mean, the team, the fund manager's salary, the team salary, and everything. I mean, even the brokerages that they need to pay to buy and sell the securities. Every expense is taken care under the expense ratio. Why expense ratio is very critical when considering a mutual fund? Expense is what you pay. So it may not sound too much once you consider that expense ratio is in the range of 1 to 2% only. However, once your corpus builds up and you make money on the returns itself, the total expense ratio can be a big amount. We will look into how 1% difference in expense ratio can dampen your return over a long period of time. But as of now, it's important to understand that the more the expense ratio for a fund, the less the returns you will generate in the long run. Direct versus regular funds, and why regular funds always have higher expense ratio. So if you invest in any fund, there are two options, direct and regular. Direct fund is always preferred because it has lower expense ratio. The commission that a fund house pays to its distributor is only in the regular fund, but with the direct fund there is no commission or there is no one in between you and the fund house. So expense ratio in case of regular fund is always high, and direct fund it's lower. Let's understand this with an example. So let's take an example of HDFC Focus 30 fund. So as of 30th June 2022, the expense ratio of regular fund is 2.3%. So let's say if you invest 10,000 rupees in this fund, you pay 2.3% as the charge. So for each 100 rupees, you pay 2.3 rupees as the charge for managing the fund. Now consider its counterpart, HDFC 30 Fund Direct Plan. The expense ratio for this fund is only 1% or 0.97% to be exact. So clearly there is a difference of 1.3% between the same funds, regular and direct. The reason being, the regular fund has to pay the distribution cost. So let's say you visit an HDFC bank and you just ask that I want to invest in HDFC Focus 30 fund. They will invest in regular fund, because for direct fund you have to invest via the website of the fund house, or some discount brokers like Zerodha or Upstocks allows you to invest in direct funds. But if you are investing via any other channel, let's say HDFC Bank and HDFC Mutual Funds are different entities. So even if you go in an HDFC Bank and invest in an HDFC fund, you are going through a channel. So then HDFC Fund House pays a commission to the channel for making the sale. And this is where the regular funds have a higher expense ratio as compared to direct funds. How the returns dampen when you invest in a regular fund as compared to a direct funds. So let's look at this with an example. So the same fund that we have seen, HDFC Focus 30 Direct Fund. So we invested say 1 lakh rupees on 1st January 2013 in a direct fund, and on the same date 1st January 2013 in the regular fund, and we just did one lump sum investment on that day. And as of say 7th August 2022, we see that the 1 lakh in the direct fund has become 3,27,000, giving us a return of 2,27,000 at a CAGR of 13.2%. Now compare that to the regular fund. The same 1 lakh rupees invested on the same day is at 3,02,000, a total return of 2,02,000 and a CAGR return of 12.2%. Clearly there is a difference of 1% CAGR return, and more importantly, now the difference of return is almost 25,000 rupees. And as the time passes by, your because of higher expense ratio, your return is dampening. Comparing just a random fund to a nifty ETF, so I made this investment of 1 lakh rupees on the same date, 1st January 2013. So on this day, I invested 1 lakh rupees in the Nippon India ETF Nifty 50. This is an ETF fund compared to Nifty, and it has given a 13% CAGR return, and that is much better than the regular fund, which is a focused fund and it invests based on growth and value both. So you can clearly see that the HDFC Focus 30 direct fund just outperforms the Nifty ETF, but the regular fund couldn't. Though HDFC Focus 30 is not a Nifty 50 benchmarked fund, still the performance of this fund is not, the regular fund is not at par with the Nifty ETF. It generally happens that if you predominantly invest in the large cap fund, Nifty ETF outperforms, and one of the reason to outperform is because it has a very low expense ratio. So any ETF has an expense ratio of only 0.05%. Now compare that to a regular fund, it's 2.3%, and a direct fund has 1%. So ETF is able to outperform, or index is always able to outperform the mutual funds, though mutual funds tries to outperform the index, but in many cases it doesn't. Warren Buffett has or in 2007 or 8 times Warren Buffett threw a challenge for hedge funds to outperform the index fund, and say for 3-4 years they did outperform, but say for 5th year or 6th year onwards, the outperformance of the index fund was much higher. You can read about, or you can Google about it in Warren Buffett's fund challenge, or $1 million. He announced that whoever can beat the index over a long period of time will win a $1 million, and in 2016 the challenge ended, and clearly the index funds was able to outperform, and none of the hedge fund at that time could outperform. We see the same story in India as well. Not all the mutual funds are able to outperform, and only selected mutual funds are able to outperform the benchmark indices. So if you want to invest in a large cap fund, direct fund is much better as compared to regular fund, but the index ETF is even better choice. So finally I have to ask, do you consider expense ratio as one of the factors to invest in a mutual fund? If no, this is the time that you should start considering it.